The stock market is currently closed, and as of the most recent closing bell on Friday, June 26, 2026, at 4 p.m. Eastern Time, Nokia stock, trading under the ticker symbol NOK on the New York Stock Exchange, finished the session at exactly $13.01 per share, marking a sharp intraday drop of 6.94%. While the broader public narrative suggests this sudden sell-off is just a routine bump in the cyclical telecommunications market, the deeper structural reality reveals that major global telecom operators are aggressively pulling back on their hardware infrastructure spending. This massive friction between general investor expectations and the actual capital allocation behavior of massive carriers creates a challenging puzzle for anyone engaged in online investing today. The surprise development catching many off guard is that despite this steep single-day decline, institutional options volume spiked to unprecedented levels near the close, indicating that massive market makers are aggressively hedging against a much wider structural shift in global network upgrades rather than a simple temporary pullback. When people look at a stock like Nokia, the common ground of investor belief is that it represents a stable, slow-moving defensive play with a dependable dividend, an asset you can just buy and forget inside a retirement nest egg. The contrarian reality is that Nokia has quietly transformed into a high-stakes valuation trap, trading at a trailing price-to-earnings multiple that has ballooned past 74 times historical averages. This is an extraordinarily steep premium for a company tethered to physical hardware deployment, making it look more like an overextended software player than a traditional industrial giant. For investors who manage their own capital through a self-investing approach on the Robinhood app or look for automated balance via Schwab Intelligent Portfolios, this extreme valuation dislocation forces a complete re-examination of risk. We are used to seeing lofty premium multiples attached to secular tech leaders like Nvidia stock or Tesla stock, where explosive top-line revenue expansion justifies the cost. But when a legacy network supplier commands the similar valuation profile, while its core market faces cyclical headwinds, the traditional thesis begins to crack under pressure. Looking closely at the recent stock movement, the daily swings tell a story of heavy institutional distribution hiding behind retail liquidity. The trading volume during the latest session surpassed the normal daily average by a wide margin, suggesting that large-scale funds are actively using the open market to trim their core positions. This institutional exit has triggered a notable downside momentum, pulling the stock down over 20% in the last month alone, even though its year-to-date performance remains visually impressive due to earlier speculative runs. For individuals executing trades via individual brokerage systems or tracking complex derivatives on the Interactive Brokers trading desk, the order book shows a significant imbalance, with massive block orders hitting the bid side throughout the afternoon. This pattern suggests that institutional wealth managers are adjusting their risk models ahead of the upcoming quarterly reports, leaving smaller retail buyers who utilize standard online investment platforms to absorb the immediate downside shock. Please take a moment right now to participate in our active tracking of investor sentiment by typing your thoughts in the comment section below. Comment below how many shares of Nokia you currently hold in your account, or share whether you are actively buying this recent dip or completely moving your capital out of legacy telecom equipment suppliers altogether. This dramatic shift in market momentum is closely tied to broader macroeconomic pressures and shifting sector dynamics that are currently squeezing the entire telecommunications sector. Rising interest rates over the past few years have made massive multi-year infrastructure loans incredibly expensive for service providers, causing them to delay major network expansions and focus strictly on conserving cash. If you review the asset allocation data within popular retail systems like Fidelity Investments or track specialized thematic funds like Fidelity ETFs, you will notice a broader rotation away from capital-intensive hardware manufacturers toward asset-light enterprise software providers. Furthermore, the rapid emergence of open radio access networks is threatening to commoditize the proprietary hardware that Nokia has historically relied on for its highest profit margins, allowing carriers to mix and match cheaper components from various vendors instead of buying integrated, expensive proprietary suites. To fully grasp how Nokia arrived at this critical juncture, we have to look past the immediate daily ticker noise and inspect its underlying business model and historical financial foundation. Nokia operates primarily as a global provider of network infrastructure, cloud software, and technology licensing, generating the vast majority of its revenue by selling advanced hardware, antennas, and routing systems to massive telecom utilities and enterprise clients. For decades, the company built its reputation on physical manufacturing and patent portfolios, a history that many mature investors still associate with safety when selecting options through traditional Fidelity mutual funds or when seeking professional guidance via Fidelity Wealth Management. Past performance reports from prior quarters show that while the company achieved decent success during the early phases of global connectivity rollouts, the overall growth rate has slowed down dramatically as those initial build-outs reached maturity across major developed nations. When you analyze the financial reports from the early part of this year, the tension between expectations and reality becomes even clearer. The company reported a significant contraction in net profit margins, highlighting how difficult it has become to maintain pricing power when massive buyers hold all the leverage. This trend has caught many users of automated services like the SoFi robo-advisor by surprise, as algorithmic models often rely on historical stability metrics that fail to anticipate sudden shifts in corporate procurement cycles. While individual investors utilizing standard platforms for SoFi investing might see the company's strong balance sheet and solid cash reserves as a safety net, the reality is that stagnant revenue growth can quickly erode a premium valuation if the macro environment remains hostile for an extended duration. Looking forward into the coming months, several distinct scenarios, catalysts, and risks will determine whether Nokia can stabilize its share price or face a deeper correction. The most immediate upside catalyst relies on a potential acceleration of enterprise private network deployments, where large industrial facilities and private corporations bypass public utilities to build their own dedicated high-speed communication systems. If this enterprise segment expands faster than expected, it could offset the current weakness seen in the public utility space and provide a genuine fundamental driver for the stock. Individual traders managing active accounts through specialized platforms like the Fidelity Trading Platform or tracking short-term breakouts via SoFi stocks are keeping a close watch on these enterprise contract announcements as a sign of structural recovery. Conversely, the most prominent risk factor remains the intensifying price competition from global rivals who are willing to sacrifice short-term profitability to capture market share in developing regions. If regional network operators continue to favor low-cost alternatives, Nokia may be forced to choose between lower margins or reduced volume, both of which would negatively impact the future cash flow projections that analysts use to justify their current price targets. To bring everything into sharp focus, the central insights surrounding Nokia highlight a profound mismatch between past market perceptions and current operational realities. The general expectation was that Nokia would serve as a steady, reliable anchor for conservative portfolios, offering a safe haven from the extreme volatility seen in high-growth tech assets like Apple stock. The reality is that the company is currently navigating a painful cyclical slowdown in global infrastructure spending, while saddled with an elevated valuation multiple that leaves absolutely no room for operational missteps. This stark contrast between investor hope and structural headwind is exactly what drove the 6.94% drop to $13.01 at the final closing bell on Friday, June 26, 2026. For anyone utilizing modern digital platforms, whether you prefer the straightforward interface of the SoFi trading platform, the comprehensive research ecosystem of Fidelity Brokerage, or the sophisticated execution of Interactive Brokers stock trading, navigating this environment requires extreme discipline. Relying on outdated assumptions about legacy brands can be a costly mistake when the underlying industry structures are shifting so rapidly. As institutional capital continues to rotate through different pockets of the technology sector, the true long-term direction of Nokia will not be determined by retail enthusiasm on popular investing sites, but by the company's absolute ability to defend its profit margins and prove that its premium multiple is backed by real, sustainable cash flow. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions.